In a recent Morningstar article, we pointed out that many of the Canadian fixed income fund categories performed well in 2017, even though there were a couple interest rate hikes in July and again in September. Why did we see many of these indexes go up when we may have expected them to move down in an increasing rate environment? We'll consider the example of the long-term bond subcategory, as it was one of the standouts, but let's briefly review what happened in 2017. There were two moderate quarter-point rate hikes in the overnight rates. The BOC indicated in their monetary policy report that the increases were primarily due to stronger than expected economic growth and a strong labor market. Taking their expectations for inflation and growth into consideration, they settled on a 1% rate to end the year. Uncertainties in the BOC's growth and interest rate projections are centered on four factors: inflation, excess capacity in the labor market, continued softness in wage growth, and elevated household debt. The latest details of the Monetary Policy Report from October point to the downside risk for inflation, with Canada's inflation rates running close to their target 2%. The moderate tightening that we saw in 2017 affected shorter-term rates as expected, but the BOC policy actions typically have less of an impact on longer-term rates. Long-term rates decreased relative to short rates, causing the yield curve to flatten, as expectations of future inflation have decreased given the short rate increase. The moderate tightening of the BOC is a move towards controlling growth in inflation, which would have served to benefit bond funds holding longer-term bonds. Longer-term rates are determined more by supply and demand characteristics in the market, driven by differing inflation and GDP growth expectations. To sum up, the interest rate effect on long-term bonds was minor given small upticks in the BOC policy rates in 2017 driven by the current state of the economy and the many uncertainties built into growth and inflation expectations. The year ahead may be expected to have moderate increases in rates, but can always surprise whenever there is more or less excess capacity than expected in the economy. For Morningstar Investment Management, I'm Rob Mee.